Okay, let's unpack this. We're diving deep into a topic that touches almost everyone thinking about their later years. How do you really make your retirement money last? It's the ultimate question, isn't
It
it?
really is.
That anxiety of running out of funds, especially if a major market crash decides to show up right when you transition from saving to spending well, it can feel overwhelming.
It's a very real concern. That initial phase of retirement, sometimes called the retirement risk zone, is particularly vulnerable to something crucial known as sequence of returns risk.
Sequence of returns risk.
And this isn't just like theoretical, it's the risk that bad investment returns early on in retirement can disproportionately harm how long your portfolio lasts because you're forced to withdraw money while your assets are down. It's kind of like trying to hike up a mountain,
Yeah.
but the first few steps are steeply downhill. You lose elevation right when you need it most.
Wow, that vivid image really hits home. And that's precisely where the retirement bucket strategy comes into play, isn't it? It's a widely discussed approach, often called the three-bucket strategy.
Yeah. The three buckets.
And it's presented as a practical way to tackle these anxieties and provide a more stable, predictable income stream throughout retirement.
Yes. Fundamentally, it's an asset drawdown strategy tailored for retirement. Its core promise is to give you a structured framework for taking money out of your investments in a way that shields you from having to sell assets during market downturns.
So it directly tries to mitigate that sequence of returns risk we just talked about.
Exactly. That's the main goal.
So for this deep dive, our mission is to cut through the noise and really understand this strategy inside and out. We've gathered quite a stack of sources, practical guides from financial planners, analyses of the approach, and yes, some genuinely fascinating academic research that offers a different perspective, maybe even challenging some assumptions.
Right. Our goal is to extract the most important knowledge nuggets from all these materials. We want to help you understand the mechanics, the potential benefits, the practicalities, and even the potential drawbacks and critical viewpoints.
Is this approach a foolproof shield, a useful tool, or perhaps, well, something else entirely?
We're going to explore it all, really, to help you decide if it could be part of your retirement plan.
Think of this as getting the full picture from the sources, not just the glossy brochure version. The what is it, the how does it work, the what are the pros and cons, and crucially, what does the data actually say about its effectiveness? Let's jump into the structure and see what our sources reveal.
Okay, let's open up these buckets.
At its absolute core, the retirement bucket strategy is built around a simple, pretty intuitive idea: organizing your investment portfolio based on when you expect to need the money.
Right. Instead of seeing your retirement savings as just one big pot, you break it into distinct sections, or, buckets.
And each bucket holds investments with a different level of risk, corresponding to a different time horizon for needing those funds.
That time-based segmentation is really the defining characteristic. As the sources explain, the primary goal isn't just organization. It's to create a reliable flow of income from your portfolio while providing a buffer against market volatility.
Especially during those critical early years of retirement.
Exactly, when that sequence of returns risk can be most damaging.
And the way it provides that buffer is, well, pretty clever in theory. By having your immediate cash needs covered by conservative assets in a separate bucket, you avoid that dreaded scenario where the market drops 20% just as you need to take out your monthly living expenses. You're not forced to sell stocks or other growth assets when their value has plummeted.
Exactly. You draw from your safe bucket, which means your riskier investments, the ones with the potential for higher returns, can stay invested.
Giving them time to recover.
Right. It gives them the crucial time they need to recover from a downturn. And over the long run, avoiding selling low can make a tremendous difference in how long your overall portfolio can sustain your withdrawals. It allows the power of compounding to potentially bring those assets back and continue growing for your future needs.
One point emphasized across several sources is the psychological aspect. This strategy provides a powerful visual and organizational tool.
Oh, definitely.
It makes your retirement finances feel more concrete and manageable. You can literally point to the cash bucket and say, okay, that's my spending money for the next 2 years, no matter what the market does.
That mental clarity and sense of security are often cited as major benefits. It really helps you compartmentalize your funds.
Right.
And another advantage mentioned is flexibility. While the classic model uses 3 buckets, the specific time horizons, the types of investments within each bucket, and the rules for managing them can be customized.
So you can tailor it to your individual risk tolerance, your spending needs, your desired lifestyle in retirement?
Absolutely. It's not a one-size-fits-all mandate in the same way a rigid, say, 4% withdrawal rate rule sometimes feels.
That makes sense. It's more of a framework, not a straitjacket. Okay, let's peel back the lid on each of these 3 time-based buckets, as described in our source materials, starting with bucket #1, the short-term bucket.
Okay, bucket 1. This is your immediate cash reserve. Its purpose is purely to cover your living expenses in the very near future. The sources typically suggest holding 1 to 2 years' worth of planned retirement withdrawals in this bucket.
And the investment philosophy here is extremely conservative, right? Safety and accessibility are paramount. Growth is like a distant secondary concern.
Precisely. The sources recommend low-risk, highly liquid assets with very short maturities. Specific examples include straightforward cash in a savings account, certificates of deposit CDs with short terms, money market accounts,
Okay.
and even treasury bills that mature just a few months, say 1 to 6 months. Very safe stuff.
The yield on these might be low, maybe not even keeping pace with inflation sometimes.
Right, but that's not their primary job.
Their job is to be there, stable, and easily accessible when you need the money for your bills next month or next year.
Exactly. Think of it as your operational cash. You need zero doubt that this money will be available at face value when you're ready to spend it.
Okay, let's use the Mr. and Mrs. Smith example that one of the sources provides to illustrate the allocation. Suppose they figured out they need $50,000 per year from their investment portfolio to cover living expenses after other income like Social Security.
Okay.
If they decide to put 2 years' worth of expenses into bucket #1, that would be $100,000.
Right, 2 times 50,000. And the source suggests an allocation within that $100,000 that's very conservative, maybe 50% in pure cash or cash equivalents like money market funds, and the other 50% in very short-term fixed income, like the short-term CDs or T-bills we mentioned. It's designed for maximum stability and liquidity.
Got it. So that $100,000 is their immediate buffer no matter what the stock market does. So what about bucket #2, the intermediate term bucket?
Okay, bucket 2. This bucket is intended to cover your expenses after bucket #1 is depleted. The typical time horizon suggested here is years 3 through 10 of retirement. So you're looking at roughly an 8-year window.
And the investment focus shifts here. You're still prioritizing stability and preservation somewhat, but you're also bringing in more assets that have potential for, well, modest growth and income.
Right. The goal is a balanced enough growth potential to hopefully keep pace with or slightly beat inflation, but with moderate risk. Examples from the sources include longer maturity bonds than in bucket #1.
Okay, longer bonds.
Maybe CDs with terms of 3 to 5 years, preferred stocks, convertible bonds, diversified growth and income mutual funds, utility stocks, often seen as relatively stable dividend payers, and even real estate investment trusts or REITs.
So the primary purpose of this bucket is kind of twofold. Generate some return in income, and crucially, act as the main source for replenishing bucket #1 over time.
Exactly. As you spend down the cash in bucket #1, the money in bucket #2 is positioned to hopefully grow and provide the funds needed to refill that short-term reserve.
Right.
Using the Mr. and Mrs. Smith example again, since they need $50,000 per year, and this bucket covers years 3 through 10, that's 8 years, they would allocate $400,000 here. 8 times 50,000.
400,000. And the investment mix described for their 400-day in bucket #2 is more balanced than bucket #1, 40% stock and 60% fixed income.
Yes, that blend provides exposure to equity growth potential, but is still heavily weighted towards the relative stability and income of fixed income. So it's less volatile than a pure stock portfolio. It's kind of a bridge between the safety of bucket #1 and the growth focus of bucket #3.
Which brings us neatly to the final piece, bucket #3, the long-term bucket. This is where the real growth engine lives, right? Holding money you won't need for a long, long time, typically beyond the first 10 years of retirement.
Yeah, this bucket is focused squarely on maximizing long-term growth potential. It holds the higher risk assets that, while volatile in the short term, have the potential to generate significant returns over many years, even decades. All right. The goal is for this bucket to outpace inflation over those decades and be the ultimate source of funds to replenish the other 2 buckets much further into the future.
So this is where you'd find the bulk of your stock market investments, your equities.
Absolutely. The sources recommend a highly diversified portfolio of equities and other growth-oriented assets. This includes broad exposure to stocks, domestic and international, across different company sizes from small cap to large cap.
So a real mix.
A real mix, yeah. While the emphasis is on growth, depending on your individual risk tolerance, This bucket might still include some bonds, but the overall allocation definitely leans heavily towards stocks.
The primary goal is clear: long-term appreciation. This bucket is designed to grow substantially, so it can support withdrawals maybe 15, 20, 30 years down the road.
Exactly. And to finish the Mr. and Mrs. Smith picture, they had a total retirement nest egg of $1.5 million.
Right.
They put $100,000 in bucket #1 and $400,000 in bucket #2. That leaves the remaining $1 million for bucket #3.
$1 million for the long term, and their allocation for that $1 million is significantly geared towards growth, 70% stock and 30% fixed income.
Which, as the sources note, is pretty characteristic of a growth-oriented allocation appropriate for that very long-term horizon. Now, if you step back and look at Mr. and Mrs. Smith's total $1.5 million portfolio across all three buckets.
The $100K, the $400K, the
Right?
withdrawal.
The overall asset allocation ends up being about 54% stocks and 46% cash and fixed income combined.
That's fascinating. So the bucket strategy isn't just about separating money. The different allocations within each bucket combine to form an overall asset allocation for the total portfolio.
Exactly. The buckets are a way of organizing and visualizing that overall allocation based on when you need the money, rather than just looking at it as a single percentage mix like 5-4-46.
Okay. Now, setting up the buckets initially is one thing, but the sources are really clear. This isn't a passive strategy. You can't just set it and forget it. Maintaining and managing it over a potentially 20, 30, or even 40-year retirement is absolutely critical.
Oh, definitely. It requires ongoing attention. The core maintenance process is the regular replenishment of bucket #1. As you draw down the cash in that short-term bucket month after month, year after year, it's eventually going to run low. It needs to be refilled.
And where does that refill come from? Primarily bucket #2.
Primarily from bucket #2, the intermediate term bucket. The money in bucket #2 is designed to be more stable than bucket #3, but still offer some growth, making it the logical next source.
Right.
You would typically move funds from bucket #2 into bucket #1 to bring the cash level back up to your target, say, that initial 1 or 2 years of expenses.
And if bucket #2 has been depleted for some reason or maybe hasn't grown enough, you might need to dip into bucket #3.
Potentially, yes. Money might flow from bucket #3 to bucket #2 and then on to bucket #1, or even directly from bucket #3 to bucket #1 if circumstances require it. But the ideal scenario, the one you hope for, is to replenish bucket #1 when the markets, and thus your investments in bucket #2 and especially bucket #3, have performed well.
So you want to refill your cash bucket by selling assets that have gone up in value, taking some profits off the table.
Precisely. If your stock-heavy bucket #3 has had a strong year, you can sell some of those appreciated assets, effectively taking gains, and move that money into the more conservative bucket #2,
Right.
and then perhaps into bucket #1.
Right.
This process of selling assets that have grown is actually a form of rebalancing, and this is where the bucket strategy often intersects with a separate rebalancing strategy.
This is an important nuance highlighted in the sources. The bucket strategy provides the structure and the timing for withdrawals, but it doesn't always explicitly dictate the investment choices within the buckets or a systematic rule for rebalancing across buckets based on target percentages.
That's right. The sources point out that the bucket strategy is often most effective when it's layered with a traditional rebalancing strategy, while refilling bucket #1 from appreciated assets in bucket #3 is a form of rebalancing.
It's kind of opportunistic rebalancing.
Yeah, exactly. But a dedicated rebalancing strategy might involve periodically adjusting the percentage allocation within bucket #3 itself, or maybe between bucket #2 and #3, regardless of whether you need to refill bucket #1 right at that moment.
Okay, so rebalancing is more about maintaining your desired risk level by keeping your asset percentages in line, while bucketing is about making sure you have cash available for timely withdrawals. They can work together, but they are distinct concepts.
Exactly. And the sources reinforce the value of staying invested through volatility by highlighting historical data. One chart shows how a balanced portfolio, something like a 60-40 mix, that experienced a major downturn, like the one that peaked before the 2007-2008 financial crisis.
Yeah, the GFC.
Historically recovered to its pre-crisis value within about 2 years.
2 years. So if you had 2 years of expenses in your cash bucket, you could have potentially ridden out that entire recovery period without being forced to sell your growth assets at a loss.
That's the idea. That historical perspective supports the core logic of the bucket strategy. Having that short-term buffer gives your longer-term assets the time needed to potentially recover and resume growth. It rewards disciplined investors who didn't panic and sell everything during the downturn.
Okay, so let's summarize the main benefits or pros of this time-based retirement bucket strategy that our sources consistently point to.
Well, the clearest benefit, mentioned repeatedly, is the excellent organization and visualization it provides. It breaks down your retirement portfolio into manageable, understandable segments tied to specific future needs,
Right.
which can prevent you from prematurely touching the assets designated for your long-term future.
It helps you avoid that temptation to dip into the cookie jar that's labeled future you.
Exactly. Precisely. Secondly, it's a form of risk management. By placing your immediate cash needs in very conservative assets, you significantly reduce the overall portfolio risk from short-term market volatility.
Makes sense.
You're not exposed to market drops for the money you need next week or next month. This also contributes to diversifying your portfolio across different risk levels and time horizons.
And we touched on this, but the flexibility is a real plus.
Yes, you can completely customize the strategy. You can decide if you want 1, 2, or maybe even 3 years in bucket #1 based on your comfort level and how predictable your spending is. You can adjust the allocation within each bucket based on your risk tolerance and tailor how you replenish the buckets based on market conditions and your spending needs.
And this flexibility ties directly into arguably the most significant benefit, according to the sources, the psychological comfort.
Oh, this cannot be overstated. Knowing with certainty that you have, say, 2 years' worth of living expenses sitting safely in cash or near cash investments, insulated from the day-to-day swings of the stock market, well, that provides tremendous peace of mind.
Especially during those turbulent times you were talking about. If you turn on the news and the market is down 20%, it's easy to panic if all your money is tied up in stocks.
Exactly. That comfort can prevent panic selling. Because you know bucket #1 is full, you're not forced to sell your depreciated assets in bucket #3 just to pay the bills.
You can ride out the storm.
You can ride out the downturn, giving your growth assets time to recover, which, historical data suggests they eventually will. That feeling of security can be invaluable for helping you stick to your plan during stressful market periods. It's a powerful behavioral advantage.
That psychological benefit is incredibly compelling. Now, while the time-based strategy is the most common application of bucketing in retirement, one of our sources introduced a fascinating other way to think about bucketing, the tax bucket strategy.
Ah, yes. This shifts the focus from when you need the money to how that money will be taxed when you withdraw it. And it highlights a major risk many retirees underestimate. Taxes in retirement. People often assume their income will drop significantly in retirement, putting them in a much lower tax bracket. But that's not always the reality.
And the source points to a couple of key reasons for this underestimation. One is simply assuming lower income than might actually be the case, especially later in retirement when maybe spending goes up for healthcare or other things.
Right. And the second reason is what the source vividly calls the ticking tax time bomb.
Ooh, sounds ominous.
It kind of is. This bomb is set when the vast majority of a person's retirement savings is concentrated in tax-deferred accounts, like traditional 401ks and traditional IRAs.
Why is that a time bomb? Because you have to pay taxes eventually.
Yes, and potentially a lot more tax than you expect. While you likely got a tax deduction on your contributions up front, every single dollar you withdraw in retirement from these accounts is taxed as ordinary income.
Ordinary income rates.
Right. And if you've built up a large balance, required withdrawals, which start at age 73 or 75 for those born later, known as required minimum distributions or RMD, they can be substantial. These RMDs are mandatory whether you need the money or not, and they can drastically spike your taxable income in retirement.
And that spike in income doesn't just mean higher income tax. It can have ripple effects on other parts of your retirement finances, right?
Absolutely. The source details these knock-on effects. For instance, higher income, potentially driven by RMDs, can trigger taxes on your Social Security benefits.
Taxing Social Security.
Yeah, and the thresholds are surprisingly low and haven't been adjusted for inflation in decades. If your income, calculated in a specific way, is between $25,000 and $34,000 as an individual, up to 50% of your Social Security benefits can be taxed.
50%.
And if your income is above $34,000, up to 85% of your Social Security benefits become taxable. For joint filers, the thresholds are $32,000, $44,000, and above $44,000.
Wow, those limits mean many average retirees could easily cross them, making a significant portion of their Social Security taxable.
Precisely. And beyond Social Security, higher retirement income can also lead to increased premiums for Medicare Parts B and D. This is known as IRMAA, the income-related monthly adjustment amount.
IRMAA, okay?
It's effectively a surcharge applied to your standard Medicare premiums if your income exceeds certain levels. So overlooking taxes means potentially paying more in income tax, losing a chunk of your Social Security to taxes, and paying more for healthcare premiums. It's a triple whammy.
That paints a very clear picture of why taxes are a major retirement risk. And that's where the tax bucket strategy comes in. It's about diversifying your assets based on their tax characteristics, not just their asset type like stocks or bonds.
Exactly. It's about building a retirement portfolio using different types of accounts, each with its own tax rules, to give you flexibility and control over your taxable income in retirement. Our source identifies three main tax buckets.
Okay, what are they? The first one is the tax-deferred bucket.
Right. This holds money in accounts like traditional 401k, traditional IRAs, maybe 403bs, things like that. Contributions were likely tax-deductible, meaning the money went in pre-tax. Earnings grow tax-deferred.
Right.
But as we discussed, withdrawals in retirement are taxed as ordinary income, and these accounts are subject to RMDs starting at age 73 or 75.
Got it. Bucket, #2, the tax-free bucket.
This bucket contains accounts where you funded them with money you've already paid income tax on, so after-tax contributions, but qualified withdrawals in retirement are completely tax-free, including all the growth.
Tax-free growth and withdrawals. Nice.
Very nice. Prime examples are Roth IRAs and Roth 401k. Other assets that can offer tax-free income include municipal bonds. Income is often free from federal and sometimes state-local tax. And certain types of life insurance policies, cash value, can often be accessed tax-free via loans or withdrawals. A major benefit of Roth IRAs, specifically for the original owner, is they are not subject to RMDs.
No RMDs on Roth IRAs. That's huge.
It is. It allows the money to continue growing tax-free throughout your lifetime if you don't need it.
And bucket, #3, the after-tax bucket.
This is your standard taxable brokerage account, savings accounts, checking accounts, CDs held outside of retirement accounts, non-qualified annuities, etc. This is money you deposited after paying income taxes on it. No upfront tax breaks.
Okay.
Any income-generated interest, dividends, or capital gains is taxed in the year you receive it or realize the gain. Interest and non-qualified dividends are typically taxed at your ordinary income rate.
But capital gains can be different.
Right. Qualified dividends and long-term capital gains on assets held for over a year benefit from potentially lower tax rates. 0%, 15%, or 20%, depending on your overall income level.
So the key benefit of having money spread across these three tax buckets is strategic withdrawal flexibility in retirement, being able to choose which bucket to pull from.
Absolutely. Imagine in a given year you need, say, $60,000. If all your money was in tax-deferred accounts, that entire $60,000 withdrawal might be fully taxable as ordinary income.
Ouch. Pushing you into a higher bracket, maybe triggering those other taxes.
Exactly. But with tax diversification, you have options. You might take $20,000 from your tax-deferred bucket, taxable, maybe $20,000 from your tax-free Roth bucket, not taxable at all, and $20,000 from your after-tax brokerage account,
where only the gain or income portion is taxed, possibly at lower rates.
Right. This allows you to actively manage your adjusted gross income, AGI, strategically each year to potentially minimize your overall tax bill, maybe stay below those Social Security and Medicare thresholds, and avoid or reduce those IRMAA surcharges.
It sounds like building a tax strategy right into your retirement savings plan from the very beginning is critical, thinking about Roth versus traditional using taxable accounts.
It really is. And having that after-tax bucket also allows you to save beyond the annual contribution limits of tax-advantaged accounts like IRAs and 401k. Plus, taxable accounts offer tax loss harvesting opportunities.
Tax loss harvesting. Selling losers to offset gains.
Exactly. You can offset capital gains and potentially even a limited amount of ordinary income each year, which you absolutely cannot do inside tax-advantaged retirement accounts.
And the source made a really compelling point about legacy planning, too, about leaving money to heirs. That hadn't fully clicked for me before.
Yes. How you hold your money dramatically impacts what you can leave behind and how it's taxed for your heirs. If your children inherit a large traditional IRA or 401k.
Tax-deferred bucket.
Right. They generally have to withdraw all the money within 10 years. Under current rules, there are some exceptions, but that's the general rule now. If your kids are in their peak earning years, those forced withdrawals get added to their already high income, potentially pushing them into an even higher tax bracket. It can significantly reduce the amount they actually keep after taxes.
So the tax burden basically transfers to the heir, potentially at a worse rate.
It can, yeah. Often at a potentially higher rate than you might have paid withdrawing it slowly in retirement. However, if your children inherit a Roth IRA,
Put in the tax-free bucket.
they also generally have that 10-year withdrawal period. But since the money was in a tax-free bucket, the qualified withdrawals are completely tax-free for them.
Wow, that's a huge difference in what they actually receive.
Massive difference. And life insurance death benefits are also generally received income tax-free by beneficiaries. So consciously using these different tax buckets can make your legacy much more tax efficient for your loved ones down the line.
That's a really powerful reason to consider tax diversification beyond just managing your own retirement income. It sounds like an incredibly valuable strategy, but
Right.
I imagine managing withdrawals from different buckets at different times, constantly considering tax rates and income thresholds, does require careful planning and discipline.
Oh, it absolutely requires an informed approach and ongoing monitoring. It's not simple.
Mhm.
But the potential benefits in terms of tax savings and overall control over your retirement income stream are pretty significant.
Okay, so we've explored both the time-based and the tax-based bucket strategies and their potential benefits. But like any financial approach, there are also criticisms and potential downsides. What did our sources highlight here on the con side?
Well, one of the most common criticisms, particularly for the time-based strategy, is complexity.
Yeah.
Just setting up the initial bucket allocations, deciding how many years of expenses go into bucket one, choosing the specific investments within each bucket,
Yeah, that allocation within each bucket.
and then managing the ongoing replenishment process. It requires careful planning. For individuals without significant financial expertise or, access to professional guidance, it can feel complicated and maybe intimidating to get right.
And that complexity can sometimes translate into higher costs, right? Transaction fees, management fees.
Potentially, yes. It depends on how you implement it. If you use different investment platforms or different types of accounts for each bucket, or maybe invest in specific actively managed funds within each bucket, you could incur more transaction fees or management costs than if you simply held all your investments in, say, one or two broadly diversified low-cost index funds. It really depends entirely on the implementation details.
There's also a criticism related to market timing risk, which feels a bit counterintuitive, doesn't it?
So-
Since the whole point of the time-based strategy is to avoid selling low due to market downturns.
Right, it seems odd. This criticism often focuses on the specific rules you set up for replenishment or withdrawal, particularly if bucket one runs completely dry during a really prolonged downturn.
Like if the market stays down for more than 2 years and your 2-year cash bucket is empty.
Exactly. If both bucket #2 and #3 are significantly down at the exact moment you have to refill bucket #1, you might still be forced to sell depreciated assets from those buckets. While the strategy minimizes this risk compared to having no buffer, a rigid adherence to refilling bucket one at a specific time or level, regardless of market conditions at that precise moment, could still expose you to selling low from your growth assets eventually.
Okay. And what about the risk of inflation, particularly in that super safe bucket #1 with all the cash and short-term stuff?
That's definitely a valid concern. The assets in the short-term bucket cash, short-term CDs, are chosen for safety and liquidity, not for growth. In periods of rising inflation, the purchasing power of that money can erode over time.
It loses value in real terms.
Exactly. While you need the safety for immediate needs, keeping too much money in these low-return assets for too long, especially in a high-inflation environment, means that money buys less and less each year. It's a necessary trade-off for safety, but it's still a cost.
And one source noted that the bucket strategy by itself doesn't really cover every aspect of managing your investments in retirement.
That's a key point. It gives you a framework for where to put money based on time horizons and how to organize withdrawals, but it doesn't inherently tell you what specific investments are best within bucket #3, for example.
Like, should it be U.S. stocks, international, small cap, large cap?
Right. Or provide an automatic rule set for how and when to rebalance your overall portfolio allocation across all buckets. As we discussed earlier, it often needs to be paired with a separate, deliberate rebalancing strategy to maintain your target asset allocation. The bucket strategy itself doesn't automatically ensure the proportional rebalancing happens across the entire portfolio, especially between the cash bucket and the growth assets.
And that point about rebalancing brings us to perhaps the most significant critical perspective we found in our sources, the academic viewpoint. One particular study really digs into the data to question whether the bucket strategy is truly superior or, as the study provocatively puts it, maybe just a suboptimal behavioral trick.
Ooh, strong words. Yeah, this study offers a fascinating challenge to the conventional wisdom around bucketing. The researchers conducted a really comprehensive analysis using historical market data from a wide sample, 21 countries, over a very long period, 115 years, from 1900 to 2014.
Wow, 115 years. That covers a lot of different market conditions.
It really does. Major wars, depressions, recessions, booms, everything. They simulated retirement periods of 30 years using a common starting point of a 4% initial withdrawal rate adjusted annually for inflation.
Okay, so a standard setup. What strategies did they compare?
They compared 11 different static asset allocation strategies against 3 variations of a bucket strategy. The static strategies were simple. Fixed percentages of stocks and short-term bonds, like 60% stock, 40% bonds, or 50-50, 70-30, etc. And the crucial element for these static strategies was that they involved periodic rebalancing.
Ah, the rebalancing again.
Yes, meaning they would sell assets that had grown relative to their target percentage and buy assets that had shrunk, bringing the portfolio back to the original allocation, say, once a year.
Okay, so static allocation with periodic rebalancing. What about the bucket strategies they tested? How are those set up?
The bucket strategies in their comparison were simplified versions, typically 2 buckets. Bucket 1 was a cash bills bucket holding a fixed number of years of withdrawals, maybe 1, 2, 3, or 5 years worth. Bucket 2 held the rest, invested entirely in stocks.
Okay, cash and stocks.
Importantly, these bucket strategies did not involve that systematic proportional rebalancing between bucket 1 and bucket 2 based on maintaining a target percentage for the whole portfolio.
So how did they decide when to take money out or refill bucket 1?
The rules for when to withdraw from bucket 1 versus bucket 2 and when to potentially refill bucket 1 from bucket 2 were based on signals from stock market performance. They tested 3 rules. 1 based on the previous year's return, BR1. 1 comparing the previous year's return to a long-term average, BR2. And 1 comparing the previous 5-year average return to a long-term average, BR3.
So market timing signals determine the bucket flows, not a fixed rebalancing schedule across the whole thing.
Exactly. The key difference is the lack of that proportional rebalancing across the whole portfolio that characterized the static strategies.
Got it. So static with rebalancing versus bucket strategies with withdrawal rules based on market signals. But without that proportional rebalancing mechanism between the cash and growth buckets, how did they measure which strategy was better? Did they just look at like how often the money ran out?
No. They went much deeper than just the failure rate, which is how often the portfolio is depleted within the 30 years. They also evaluated strategies based on a few other things.
Like what?
Shortfall years. For the instances when a strategy did fail, how many years short was it on average? This gives you a sense of how bad the failure was, not just if it failed.
Okay, the severity of failure.
Right. Then risk-adjusted success, RAS. This is a measure of the overall number of years the portfolio provided withdrawals, including any money left over, the bequest, after 30 years relative to the volatility, the ups and downs of those outcomes. A higher RAS means more consistent and potentially longer success for the risk taken.
More bang for your risk bucks, sorta?
Kind of, yeah. And finally, downside risk-adjusted success, DRAS. This is similar to RAS, but it only looks at the volatility and outcomes in the periods where the strategy was failing or likely to fail. It focuses on how well a strategy manages risk, specifically during the really difficult market periods.
Those metrics provide a much more nuanced picture than just pass-fail. Okay, drum roll. What were the study's crucial findings across this comprehensive comparison and these metrics?
Well, this is where it gets really interesting and, frankly, challenging to the popular narrative around buckets. The study found that across the comprehensive sample of 21 countries and evaluated by all 4 metrics, failure rate, shortfall years, RAS, and DRAS static strategies consistently outperformed the bucket strategies they tested.
Consistently outperformed, even with all that data, 115 years, 21 countries?
Yes, that was a striking finding. Let's look at the U.S. data specifically from 1900 to 2014. The best performing static strategies, particularly balanced allocations like 60% stock, 40% bonds, or even 50% stock, 50% bonds, showed very low failure rates. In fact, the 60-40 static strategy never failed once in this entire 115-year U.S. data set under the 4% withdrawal rule simulation.
Never failed. Wow.
And these static strategies also had high risk-adjusted and downside risk-adjusted success scores. In comparison, the best-performing bucket strategies tested in the study, those BR2 and BR3 rules based on market signals still showed higher failure rates, more shortfall years when they did fail, and lower RAS and DRAS scores compared to these leading static strategies. They just didn't hold up as well on average.
What about the global average? Did the pattern hold across all 21 countries?
Pretty much, yeah. Static strategies, on average, outperformed the bucket strategies across the board globally, too. For example, a simple 50% stock, 50% bond static strategy, while having a slightly higher average failure rate globally than some of the bucket strategies, still showed better performance in terms of lower shortfall years and higher risk-adjusted success metrics overall. It proved more robust across diverse global market histories.
They even looked at how many years you put in the cash bucket, right? Like 1 year versus 2 or 3. Did that change things significantly?
They did perform a sensitivity analysis on the U.S. data, varying the amount held in the cash bucket of their simplified bucket model 1, 2, 3, or 5 years of withdrawals. The results showed that having just 1 year in cash performed better among the bucket strategies tested.
Only 1 year. Why? Likely by minimizing the drag of that low return cash on overall portfolio performance while still offering just a small buffer. But here's the kicker. Even this best performing bucket configuration, the BR3 rule, with just 1 year in cash, still underperformed the best static strategies, like a 70-30 or 50-50 static allocation with rebalancing, across most of the evaluation metrics for the U.S. data.
So even tweaking the bucket strategy didn't make it perform as well as simply sticking to a diversified allocation and systematically rebalancing it back to target. This really begs the question, why? Why did the static strategies consistently come out on top in their analysis? What's the mechanism?
The academic source provides a pretty clear explanation for this. The fundamental difference lies in that rebalancing mechanism we keep coming back to.
Right.
Static strategies commit to periodically adjusting their portfolio back to the target percentages, say, every year. This means if stocks have gone up and now represent more than 60% of a 60-40 portfolio, the investor systematically sells some stocks, taking profits.
Selling high. Right. And crucially, if stocks have gone down and now represent less than 60%, the investor systematically buys more stocks using money from the bond portion, which would now represent more than its target, 40%.
Buying low. Rebalancing forces you to sell assets that have become relatively expensive and buy assets that have become relatively cheap.
Exactly. It's a systematic, disciplined way to execute the buy low, sell high principle over time, capitalizing on market fluctuations rather than just riding them out. The bucket strategies tested in this study while aiming to protect against selling low by drawing from the cash bucket during downturns.
Which is good.
Which is good, yes.
Yeah.
But they generally do not have that built-in mechanism to proportionally rebalance the entire portfolio, especially not to consistently buy more of the growth assets, like the stocks in bucket #3 when their price goes down. They avoid the sell low downside during market drops, but they largely miss the opportunity to systematically buy low that disciplined rebalancing provides. And that, the study argues, is a significant driver of better long-term performance for the rebalanced static strategies.
Wow. That is a really powerful insight. So the psychological comfort of avoiding selling low might come at a hidden performance cost because you're also missing the systematic opportunity to buy low that a regularly rebalanced portfolio offers over the long term.
That appears to be the key takeaway from this specific academic perspective. The behavioral benefit of compartmentalization and avoiding forced selling is definitely real and valuable, but the typical lack of systematic proportional rebalancing across the whole portfolio in many bucket approaches can lead to suboptimal long-term financial outcomes, compared to strategies that bake in that disciplined buy-low opportunity through regular rebalancing.
This really creates a paradox, doesn't it? The bucket strategy is incredibly popular among financial planners. It seems intuitive to retirees. It offers significant psychological comfort. We've established all that. Yet, this rigorous academic evidence, looking at over a century of data, suggests that simpler static strategies with systematic rebalancing may actually lead to better long-term results in terms of portfolio longevity and performance. Why the disconnect? Why is bucketing so popular if the data says rebalancing works better?
Yeah, it's a puzzle. The sources in the study itself touch on this. One factor might simply be a lack of widespread awareness of this specific type of academic research among the broader population, and maybe even among some practitioners. The study itself points out that there's been relatively limited academic work specifically comparing these bucket strategies head-to-head with rebalanced static strategies over such long historical periods and across multiple countries.
So the marketing message and the intuitive appeal might just outweigh the less accessible academic data for many people.
Potentially. And we keep coming back to that psychological comfort as a powerful, tangible benefit. Knowing those immediate expenses are safe makes you feel better, less stress.
Which is huge.
It's huge. And that feeling can prevent impulsive, damaging financial decisions during market turmoil. This feeling of control and security might simply be prioritized by many people over potential, maybe marginal, long-term performance gains from a strategy that feels riskier because all the money is technically in one pot, even if that pot is being systematically rebalanced.
It taps right into that behavioral bias known as mental accounting, treating different pots of money differently based on where they are or what you intend to use them for, even though financially all money is fungible.
Exactly. The bucket strategy aligns perfectly with that mental accounting tendency, making it feel very intuitive and responsible. So the trade-off seems to be between that very real, significant psychological benefit and behavioral support on one hand.
Which helps you sleep at night.
Right. And potentially sacrificing some long-term performance and portfolio longevity compared to strategies that might be less psychologically intuitive, but are supported by quantitative historical data showing the long-term power of systematic rebalancing.
Okay, this has been a truly comprehensive deep dive. We started by acknowledging those core retirement anxieties, the fear of running out of money, that sequence of returns risk. And we introduced the popular time-based retirement bucket strategy as a proposed solution, breaking down its 3 buckets: short-term for immediate needs, intermediate for mid-range needs, and long-term for growth, illustrating with the Mr. and Mrs. Smith example.
We explored the crucial ongoing management of the strategy, particularly replenishing that short-term bucket, and noted how it often needs to be layered with traditional rebalancing for best results.
Right.
We also looked at the vital tax bucket strategy.
Which was fascinating.
Yeah, highlighting the often underestimated impact of taxes in retirement and how diversifying across tax-deferred, tax-free, and after-tax accounts can provide valuable flexibility, help mitigate RMDs, and potentially protect Social Security benefits and even your legacy.
We definitely covered the clear benefits of bucketing, the organizational clarity, the risk management aspect, the flexibility, and that immensely important psychological comfort factor.
But we didn't shy away from the potential downsides and criticisms either, such as the complexity, potential costs, the inflation risk in bucket 1, and the fact that the strategy itself doesn't fully define investment selection or that automatic proportional rebalancing piece.
And finally, we delved into that compelling academic research that provides a really critical perspective, suggesting that while bucket strategies are popular and intuitively appealing, static asset allocation strategies that include systematic rebalancing have historically demonstrated better performance and longevity metrics across various global markets and time periods.
Largely due, it seems, to their consistent ability to buy low through that rebalancing discipline, an opportunity often missed by simplified bucket models that focus primarily on avoiding the sell low.
So the key takeaway, the central lesson from navigating all these different sources, seems to be this. The bucket strategy is a powerful behavioral tool, no doubt about it. It provides valuable psychological comfort and a clear organizational framework. It can help retirees feel secure about their immediate expenses and avoid panicked selling during market downturns. It makes retirement finances feel more manageable.
However, there's a but. The rigorous quantitative evidence, particularly that academic study we reviewed, suggests that a strategy that systematically incorporates rebalancing like a traditional static allocation, consistently brought back to target, may be more effective over the long term at maximizing portfolio longevity. It does this by consistently executing that crucial buy low, sell high principle through market cycles, which bucket strategies, at least in their simplest common forms, may not fully capture as effectively.
Which leaves us, and you, the listener, with this final provocative thought to mull over as you think about building or refining your own retirement income plan. In managing the anxieties and the realities of funding a potentially decades-long retirement, how do you personally weigh the very real, tangible benefit of peace of mind provided by a structured, intuitive strategy like bucketing against the potential for improved long-term financial outcomes and portfolio longevity suggested by data-driven approaches focused on systematic rebalancing? It's really a fundamental tension in personal finance, isn't it? Balancing that behavioral comfort and clarity with quantitative evidence and potential optimization. Definitely something worth contemplating for your financial future.
Indeed. A lot to think about there.
Except like